If you could add one superpower to your investing toolkit, what would that be?
That's a great question. Honestly, of course, the superpower you wish you can see the future, but I hope none of us have that superpower. Then it would not be interesting enough, right?
Okay, and in a snap, what's the first metric you check when the market opens?
Honestly, I'm not so much a market person. I don't focus too much on the market in the short term.
In one word, how would you describe the market's mood these days?
Yeah, so it's volatile.
In the current market conditions, according to you, what would be an ideal portfolio? What would it look like?
I don't think you can give idle portfolios because I believe investing is very personal. So it's a function of asset allocation, which is very specific to a person. So I don't think there is one right answer. If you ask me what are the preferred places to be in the market, I would say large caps and balance advantage funds on the equity side. And on the hybrid sides, it's multi-asset funds.
Your one line advice to investors.
I think just stay invested.
Hello, and welcome to our exclusive interview series where we connect with top fund managers from leading AMCs to bring you expert insights. Joining me and my colleague Chirag today is Ramesh Mantri. He's Director Investments at White Oak Capital AMC. Welcome, Ramesh.
Thank you.
Great. Now, time to jump into the deeper questions. The equity markets, they've been volatile after the US announced tariffs. So, do you see this as a start of a prolonged consolidation, or are we on the verge of a quick recovery?
So, Shira, it's impossible to predict markets in the short term. To us, predicting markets in the short term is equivalent of calling a toss in a sports. You're going to get it right half the time, and half the time you're going to get it wrong. The fallacy is when you get a couple of tosses right, you start believing that you can call the market. So I wouldn't try to predict. Clearly, of course, when you're talking about all this, one, the markets have given a very clear pronouncement that these proposed tariff regime by the US administration is very disruptive. That message has been given loud and clear. And I think even the US administration has acknowledged the fact that they're willing to negotiate, right? So hopefully, better sense will prevail in the days and months to come, and we are going to see a new regime. There'll be a new regime for sure, which will be acceptable and less disruptive than what it is today.
Mr. Mantri, with the challenges of the weak domestic growth and rising geopolitical risk, which domestic and the global factors do you think will drive the Indian economy going forward?
Yeah, so Chirag, again, I would say it's almost just like you can't call markets. It's very difficult a priori to get sectors right. Uh, of course, there is going to be a lot more. There is global, let's say, policy uncertainty on the global sectors, and there is some amount of slowdown on the domestic sectors. Both of them are playing out as we speak now. So it's a very interesting balance to play in your portfolio. Now, coming to where sectors where fundamentals are still very good, valuations are right, I would say it is the banking sector. I would say large private sector banks, large banks particularly, or even other parts of financial services like insurance and all. This is where there's still good growth, fundamentals are good, and valuations are right. I don't know what is going to drive which sector is going to drive the market recovery, but that's where I would deploy more capital.
Okay, and following the recent market correction, are Indian equities now attractively priced, or do you believe they're still trading at a premium?
That's a good question. See, actually, large cap equities, right, when we look, are now more or less trading in line with long-term valuations. So it's actually a time to start deploying money in large caps. I would still say, if you look at small and mid, they are, say, still 20% premium to long-term averages, right? So I would say, and considering that in an environment of uncertainty, both local slowdown and global uncertainty, it's harder for smaller businesses than larger businesses. In a difficult environment, usually the strong becomes stronger and the weak gets weaker. So I would say structurally, considering where valuations are, large caps are a lot more attractive than small and mid.
Mr. Mantri, could you share your core investment philosophy and how do you adjust across different market cycles, especially during the uncertain times as we are witnessing right now?
Yeah, so our core investment philosophies, outsized returns are earned by investing in great business at attractive valuations. You'll hear, Chirag, often this philosophy from a lot of other fund managers: buy quality businesses, at the right price. I would say it is not investment philosophies that matter. The differences in investment philosophy. It's actually the execution of the investment philosophy that matters. People think investing, you have to have a different answer. Actually, the challenge is executing your philosophy every day. See, I'll give a very simple example. Everybody knows what you need to do good for good health: eat well, exercise, sleep well, live a stress-free life. By the way, I've known this answer for thousands of years. The challenge of good health is not what you have to do for good health. The challenge is everyday execution, right? Similarly, investing philosophy is not the philosophy, but everyday disciplined execution of the philosophy. That's what matters. And uncertain times, I think one of our core tenets of how we build portfolios is to have balanced portfolios. So we are generally not the macro investors or thematic investors who take top-down bets. We are fundamentally bottom-up investors. We spend a lot of time understanding businesses on the ground. And we want to make sure our portfolio is pretty consistent in terms of performance, and performance comes through stock picking. So ideally, I would like my portfolio to outperform in an up market and also in a down market. That is what it has played out in the short history for the mutual fund. And now we started experiencing both the cycles. So our portfolio is actually balanced. So logically, if we are adding value because of picking the right stocks, it should deliver performance in both cycles, up and down.
How does the valuation factor plays the role in stock picking?
So I use the word attraction. So valuation is a critical input into making the getting stocks in the portfolio. It's a combination of a great business and valuation. Just because a business is great, but the valuations are very high, it will not make into the portfolio. Similarly, for us, it's essential that we are not looking to just buy very cheap, poor quality businesses, right? So both have to come together. Valuation is important for for us to generate alpha. It's important for position sizing, right? I'll just give you a simple example. Let's say there are two companies with similar business. One has a higher upside versus other. Invariably, the position size with the stock with the higher upside will be a lot more than the stock with the lower upside. And if let's say one of the other companies has no upside, that stock will not be part of the portfolio. So valuation is a super critical input into the investment decision making.
Sir, could you just elaborate on how do you decide on the upside of stock? You spoke about the stocks having the bigger upside, but then how do you decide which stock has the higher upside?
Yeah, great question. So first, we have our own proprietary OpCo-FinCo framework that we use to analyze values. See, our fundamental assumption as a bottom-up investor is that the market on aggregate level is fairly valued. Now, within that, there may be stocks that are overvalued and undervalued. So we value every stock in the market relative to the sector and relative to the market. Every stock, we ascribe valuations to it. Within that framework, there'll be some stocks that are overvalued and some stocks will be undervalued. That's how you get to a zero upside. There'll be some stocks which are overvalued, some stocks which are undervalued. So mathematically, you should end up with a zero upside. And because of that, invariably, you'll have part of the market that's a lot more attractive, and of course, a part of the market that's less attractive. And then within the attractive pool, we make the portfolio.
Small and mid-cap stocks, they have taken a hit recently. So do you view this as a buying opportunity for quality names, or are their valuations still too high?
Yeah, so one, let's understand this. When people talk about this hit, there have been a great 2 years for small and mid before this, right? From let's say March, 2 years, very strong rally, right? So one, at an aggregate level, they really small cap, mid cap had gone up. And even as I said, even today, when you look at the attractive relative valuation between small and mid cap versus large cap, small and mid is about average 20% more expensive, right? Now that is an aggregate level. Within aggregate, of course, there are a lot of opportunities. And I would say that the correction we saw in Fed was fairly indiscriminate. it did not distinguish between good quality companies and poor quality companies. So that's a very good opportunity for a fund manager to actually improve the quality of your portfolio. If let's say inferior business and a good business both fell at the same rate, right? In fact, you can reduce your position in your less good business and deploy the capital there. So I would say, as we speak, there are a lot of interesting opportunities in small and mid. But is there across the board a screaming buy opportunity because of this recent correction? The answer is no.
Several of the White Oak equity funds have delivered strong one-year performance, being in the top quartile. What key decisions and market factors have contributed to their success?
Now, that's a good question. First of all, generally, the way because we build balanced portfolios, we try to make sure market factors have less impact on the portfolio and the performance is generated through stock picking. Since June onwards, the market has changed tune. Earlier, there was one-sided market rally, particularly on small and mid cap, and poorer the quality of the business, the more the stock ran, right? But now you have a more bottom-up market where certain companies which are doing well, the stocks are doing well, and certain stocks have fallen apart. So it's been a very good environment for a stock picker, for someone to create alpha. And our ability to pick stocks has actually become very useful. Number two, in our portfolios, there's a lot of focus on governance. Now, in a bull phase of the market, people ignore governance. But now that the markets have slightly wobbled in the last 6 months, there's a lot of focus has come back on governance. And that quality factor has started playing out very well in the market. So I would say it's a very good environment to be a bottom-up fund manager because there's no longer one-sided market.
Sir, if you could elaborate what stocks or what sectors have helped the funds perform better?
No, there of course will be individual stocks in the last 1 year which have done very well. But I would say when I look at the attribution of analysis of our, let's say, FlexiCap fund, the winners come from large cap, mid cap, and small cap. They come from a variety of sectors, including IT, industrials, consumer, financials, pharma. So I would actually not like if my portfolio is composed of just one market cap. Winners come only from one market cap or one sector, which only means that only one of your players in your team is performing. You have one great player in your team and is performing. The best teams are the ones where there's not one great player, but a number of good players. So for us, when I see the attribution analysis of our portfolio, number of sectors have done well, number of market cap categories have done well, which is what we want it to be.
Some funds like the large cap, multi cap, ELSS, and I think even the mid cap, they haven't performed as well, underperformed their peers in 2025. So, what do you think this led to this underperformance, and how are you planning to adjust these portfolios?
No, great. So first of all, we're just talking of 3 months, 25, right? I don't think we should even discuss performance of any scheme on what happens on a quarterly basis.
Okay.
Let me give you more context now here. See, our portfolios typically tend to be overweight small and mid versus the benchmarks. That's something you'll see a very clear style across our schemes. Now, of course, you can ask me, you said you're thinking valuations slightly higher in small and mid. That's true, but yet our portfolios tend to have overweighted small and mid. The reason for that is different. We believe one, small and mid cap sectors provide a lot of alpha potential for active managers because your competition is a lot more weaker. These market caps are a lot more inefficient than large caps. Number two, because of our deep investment in research, we as a firm are very, very extraordinarily well positioned to create alpha in small and mid. So it's our conviction that we can generate over longer periods systematically much higher alpha by being overweight small and mid. Now, because the last 3 months, small and mid has significantly underperformed large caps, you are seeing some of the drawdown, right? But to us, that is just transitory factor. Longer term, that's actually a key advantage for us to create alpha.
As mentioned, will you continue to remain overweight in the small and mid caps even going forward?
Yeah, so see, in some fund categories, there's a lot more flexibility. For example, flexi cap to allocate or be overweight. Large caps, practically, you can only be 15% off large caps. The window of room of window to non, say 80% a large cap fund has to be large cap, and practically you have to be at 85. So there's a very small window in a large cap fund to own it differently. Number two, in a multi-cap fund also, every market cap category has to be 25, 25, 25. Practically, you have to be at a much higher number, So some fund categories, the room to be very different is lesser. In a category like flexi cap, you have a lot more room to run very different portfolios because of the way the definition of the category works. So in a flexi cap category, we would always be a lot more overweight small and mid. It's harder to be in large caps, all right? And of course, multi-cap, there is room to do that to some extent. But as of now, we are not significantly overweight small and mid in multi-cap.
Funds like flexi cap, mid cap, multi asset ALSS fund has more than 100 stocks in the portfolio, while multi cap holds around 170 stocks in the portfolio. Is this a strategy for the diversification part of the portfolio rebalancing phase, or a long term approach?
Great question, great observation. We get this question very often. See, I think for us, it's very clear. The large number of positions exist to maximize alpha in the portfolio performance, alpha in the portfolio. Let me explain that. But before I come to that, let me give you a more philosophical answer, even more practical answer here. There's a fallacy in the market, misunderstood, that concentrated or high conviction portfolios tend to do well. Let me show you example. The greatest fund manager that we all know, a mutual fund manager, was Peter Lynch, right, of Fidelity. He had an average over 200 positions through his entire career. That's the greatest fund manager we know. In mutual fund industry in India, we have the diversified category and the focus category. Invariably, over the long term, diversified category has outperformed focus category. So first two data points to prove that diversified works well. Now, why do we have a large number of stocks? The simple reason is White Oak has the advantage of having one of the best resourced investment teams in the industry, just not in terms of size, but also quality. So we are able to go down the market cap curve and identify great companies which are very small at early stages. Just before this call, I did a meeting discussing a company with a market cap of only 500 crores. How small it is. Now, let's say if I find this company of 500 crores as a brilliant company, which I think is a multi-bagger on a 5-10 years basis. Now, remember, because the company is so small, I cannot take a large position. Neither can anybody else take a large position. Now, question is, can I buy 25 bips of my portfolio? Possibly, yes, in this position. Can I buy 1% of my portfolio? The answer is not possible. I have an easy decision to take 25 bips of my portfolio and put it into a large cap. But if I think this 25 bips over a long period can create a lot of alpha, I think that's a smarter way to allocate capital. So I'm happy to invest 25 bips, 50 bips, 35 bips in a lot of high potential companies at their early stages. As long as we believe over a longer period, they will create a lot more alpha than the default option to invest in large caps. So it is two factors. One, the fact that we have a large investment team that can go down the market cap curve, and the fact that we are comfortable taking short-term risk to maximize the alpha in the portfolio. So actually, this ability, this large long tail of the portfolio is actually a tool to maximize alpha over the long period.
Okay. Do you use momentum indicators in your portfolio construction?
No, we are fundamental equity investors. We don't use either momentum or technical or quant factors.
How do you approach the sector selection, and what degree do the benchmark influence your decisions?
So, see, our idea is very clear that portfolio performance should come through stock picking. So it should not come either because of market timing. It should not come because of taking very big calls on sectors. Because ultimately, sector calls are quasi macro calls. Let us say if you're taking today a bet that you want to be bearish on IT, effectively you're bearish on US. You're taking a macro call on the US economy, right? We believe nobody gets this right. These are like getting the toss in a cricket match, right? Half of the time you'll be right, half of the time you'll be wrong. So our style is, if there is a sector that we believe has a large number of opportunities today, and there's a lot of heterogeneity in the sector. For example, something like consumer discretionary, variety of companies from auto to your retailers to your apparel retailers to alcobev companies to jewelry companies, and you believe you can understand those business models, then that sector you can be overweight, because that overweight will get compensated by the fact that you can generate a lot of alpha. But per se, our style is not to take big bets on sectors, because sector bets fundamentally are macro bets.
Now, with a relatively small mid-cap universe, are you still finding attractive opportunities, or is it becoming more challenging to uncover hidden gems now?
First of all, I would say there are 150 stocks as per definition,
Yeah.
and you are only required to own, let's say, practically about 70% of the portfolio in them. The 30% of your portfolio can be very different. We at White Oak have chosen that the rest of the portfolio ought to be predominantly small caps. Some of them will become mid caps if they do well, the future mid caps, right? So if you look at active shares of our portfolio of the mid cap fund, they are 60% or north of 60%. So clearly it's a well run active fund. So there's no shortage of opportunity.
Given the recent market volatility, what advice would you give to investors? Should they hold steady, rebalance their portfolio, or wait for more clarity?
See, first of all, Chirag, this volatility of equities. If people in India have earned double-digit returns over long-term on equities in India, is because you have to take the pain of volatility, right? This is a feature of equity markets. Unfortunately, in the last post-COVID, volatility was very low and people actually made a lot more returns. So people were making 20% return plus returns and low volatility. So a lot of people who come first time to equity markets have wrong expectations from equity markets. First of all, the long-term returns of Indian equity market are 12 to 13%, which is in line with the long-term nominal GDP growth plus dividend yield. Number two, there's a fair amount of volatility. If you look at even the last 35 years, despite this compounding. So volatility is a feature of equity product. So one, I think people have to mentally accept that. And that is why people first need to expand their horizons. If you're looking at equity market returns for 1 or 2 years, equity does not work. Equity at least needs 5 years to work in your favor. And the longer you stay investing, you then actually become more and more believer in equity. I think one product that makes volatility your advantage in investing. Now, often people think of this solution as a systematic way to invest in equities. How do you save money every day? When people talk of SIPs, people think of SIPs as a regular way of investing. Actually, SIP is actually a great way of managing the volatility, because in a down market, you get actually a lot more units. And when the market goes up, the portfolio value goes up. So actually, SIP is a great way to make volatility of equities as your friend. So 2, 3 things I have recommendations. First is one needs to have a long-term orientation. I also strongly feel that investing equity is not so much a game of intellect. It's a game of behavior, right? And just like nobody remembers their doctor when they're keeping healthy, you only remember your doctor when you're not keeping well. So it's important that you had someone to advise you, hold your hand in your investing journey, right? It may be an IFA, whoever it is. It's harder to go on through this journey on your own. Like, for example, I struggle to go to a gym without a trainer. I know the exercises, but the gym trainer exists to have that discipline. So we need someone to hold our hands. This is very critical.
So one
And
last
number three, I think very critical is I think people need to do a very thoughtful asset allocation, understand their risk appetite, risk tolerance, and then stay disciplined to asset allocation. And fourth recommendation, I think Value Research is a great platform for investing. And this is one of the rare platforms that I would recommend all investors to follow.
Great. One last question before we let you go. So after the recent correction, which sectors or themes do you find appealing and which ones do you think are still overvalued?
So again, not generally believing in top-down views on sectors, but where I see fundamentals are good and valuations are good, right? That is one is BFSI broadly, because where fundamentals and valuations are attractive. So we are now overweight that space. Other space, which I believe where India has very strong long-term competitive advantages, is pharma and healthcare. Pharma on the export side, where 50% of the US generics are made in India. And if the US wants to diversify away from China, we are a suitable partner, despite all these rhetorics of tariffs. Number two, healthcare is a very defensive sector. When someone is sick, they don't ask for food, they ask for medicine and healthcare. So, and people, when they get richer, they always go for better quality of healthcare. Nobody ever asks this question, I want a cheaper doctor. They only ask, I would need a better doctor. So healthcare is a very defensive form of consumption. So pharma and healthcare for a long term.
Well, that's all we have for you today in this conversation. Thank you for sharing your insights, Ramesh. We look forward to our audience gaining valuable perspective from today's discussion. Thank you.
Thank you, Ruchira and Chirag, for hosting me.